Before every single flight, I run a checklist. It doesn't matter if I've flown that route 100 times. It doesn't matter if everything looks fine from the outside. You go through the checklist, every item, every time, because the whole point of the checklist is to catch what you can't see just by looking. Dividend investing works the same way. This is Captain Pierce. Welcome back to SkiesCapital. Think clearly, invest better. A stock with a 7% yield looks great on the surface. Smooth skies, nothing unusual on the panel. But if you don't go under the cowling and actually check the numbers, the payout ratio, the free cash flow, the balance sheet, you might be flying toward a cut you never saw coming. And when a dividend gets cut, it hits you twice. You lose the income, and then the stock drops. I've seen it happen to investors who didn't run the checklist. Today, I'm giving you 3 things to check every time before you buy a dividend stock. 3 items, 3 instruments on the panel. Run all 3 every time. Let's go. So first, what does it actually mean for a dividend to be safe? A safe dividend is not just a dividend that gets paid today. It is a dividend backed by enough real cash flow to keep paying through good times and bad, without straining the balance sheet, starving the business, or setting up a future cut. In other words, a safe dividend is a durable dividend. And here's what many investors miss. A high yield is not the same thing as a safe yield. In fact, a very high yield is often the market's warning light that something may be wrong. Why? Because yield rises when the stock price falls, and the stock price usually falls before the dividend gets cut, not after. So, if you see a 7%, 8%, or 9% yield, do not just assume you found income. Sometimes what you found is risk. I've been tempted by high yields too. Most income investors have, but discipline means looking past the headline number and checking what is actually holding that dividend up. That's what this video is about, not chasing yield, checking the engine behind it. Here's why this checklist matters so much. First, dividend cuts hit you twice. You lose the income, and the stock price often drops hard at the same time. Sometimes 20, 30, even 40% in a day. That is a rough flight. Second, yield can be deceptive. A 9% yield may look attractive, but if the payout is not sustainable, that yield is a warning light, not a reward. The market is often signaling doubt before the cut ever happens. Third, if you depend on dividends for real income, durability matters more than yield. Whether it is retirement income, living expenses, or simply reliable cash flow, a dividend cut can force real changes. Safety first, yield second, and fourth, beating earnings does not automatically mean the dividend is safe. A company can post a solid quarter and still have a fragile payout if cash flow is weak or debt is creeping higher. You have to look past the headline. That is why this checklist matters. No single number tells the whole story. You need all 3 instruments working together. All right, here are your 3 checks. Run all 3 before you trust a dividend. Check 1, payout ratio. This is simply dividends divided by earnings per share. It tells you how much of the company's earnings are being paid out to shareholders. In most cases, a payout ratio below about 75% is where you want to be. Some sectors, like utilities or REITs, naturally run higher. That is normal, but for most industrials, healthcare names, or consumer companies, if the payout ratio is consistently above 90% or worse, over 100%, that is a warning sign. The company is paying out nearly everything it earns or more than it earns. One rough quarter and something can break. That is your first instrument check. Check 2, free cash flow coverage. This one matters even more. Why? Because earnings can be influenced by accounting. Free cash flow is the real cash left after the business operates and maintains itself. That is what actually funds the dividend. What you want to see is free cash flow comfortably covering the dividend, ideally by about 1.5 times or better. So, if the company pays $500 million in dividends, you would like to see at least $750 million in free cash flow. That gives the payout room to breathe. If free cash flow barely covers the dividend, or does not cover it at all, that dividend may be living on borrowed time. That is your second instrument check. And honestly, it is the one I trust most. Check 3, balance sheet strength. This is the one many investors ignore until it is too late. A dividend may look covered today, but if debt is rising and flexibility is shrinking, that safety can disappear fast when the business hits turbulence. A heavily leveraged company has fewer options when revenue slows, margins compress, or refinancing gets expensive. 2 things to watch here. Is debt to EBITDA rising or falling? And does the company have enough operating income to cover its interest expense comfortably? Those numbers tell you whether the balance sheet is strengthening or getting more fragile. A strong balance sheet is reserve fuel. It gives the company options when conditions get rough. Now let's talk about the warning lights, the things that should make you stop and look more carefully. Payout ratio consistently above 90% or above 100%. The company is stretched. One bad quarter can force a cut. Free cash flow barely covering the dividend or not covering it at all. If FCF is weak or inconsistent, the payout is on borrowed time. Debt rising quarter after quarter with no clear plan. A deteriorating balance sheet is one of the most reliable leading indicators of a cut. Management getting vague about the dividend on earnings calls. Evasion is a signal. Listen carefully to the language. None of these individually breaks the thesis automatically. But when you see 2 or 3 of them together, that's the checklist telling you something is wrong. Now here's what you want to see. The green lights on the panel. Check payout ratio reasonable, stable, or trending down over time. The earnings growth slowly reducing the payout ratio is one of the best signs of health. Check mark free cash flow consistently exceeding total dividends paid by 1.5 times or better. Room left over for reinvestment and debt reduction after the dividend is paid. Checkmark clean balance sheet, debt falling, interest coverage healthy and improving. Financial flexibility is what lets a company maintain the dividend through a downturn. Long track record of dividend growth, not just maintenance. Companies that raise the dividend year after year are showing confidence in earnings power. These signals don't guarantee anything, but they point in the right direction. And when all 4 are present together, the dividend usually earns its place in a portfolio. Here's the final approach for day 16. A safe dividend is not about finding the highest yield. It's about finding the most durable one. 3 checks every time. 1, payout ratio. Keep it at a level the business can sustain through the cycle. 2, free cash flow coverage. Earnings can be managed. Cash flow is harder to fake. 3, balance sheet strength. Rising debt is often the quiet early warning sign before a dividend cut. Watch it carefully. Run all 3 before you trust a yield. That's the pre-flight check for income investing. And remember, turbulence is not a change in flight plan. If you own a dividend stock with a strong checklist and the price dips, that's not automatically a reason to panic. It's a reason to rerun the checklist and confirm the thesis is still intact. This has been Captain Pierce with SkiesCapital. Think clearly, invest better. If this helped, subscribe and ring the bell. Drop your questions or your own approach to monitoring dividend safety in the comments. I'll see you on day 17. For educational purposes only, not investment advice. Keep the blue side up and safe skies.